Ladies and gentlemen, post Powell, we are seeing a face ripper short squeeze rally in a lot of names. The broad indexes, the S&P 500 touched as high as 2% positive just a couple of minutes ago. AMC stock as well, seeing a pretty green day, up about 4% at the time of recording this video. We are going to get into everything you need to know on AMC, on GME, as well as the broad markets here in this intraday update. And let me tell you guys, the data behind these two stocks in particular still looks very bullish. So we have a lot to do. We have a lot to get into. Not enough time to get into it. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. So, first things first, what is really happening today? Well, Fed Jerome Powell yesterday gave us this kind of dovish, hawkish rate hike. There was a lot of uncertainty with what he said. Even when it came down to a soft landing, Fed Jerome Powell said there is still a pathway to get there, and we're certainly looking for it. That is pretty uncertain. That was one of the comments that made the markets move pretty big yesterday. Other comments being just the overall sense that inflation is the real problem. People wanted the Fed to highlight the banking crisis and what they are going to do from here. And really the markets wanted the Fed to take a much more dovish approach to the economy, given what is happening in the banking system, right, with the regional banks. Because after all, these banks going bankrupt is very disinflationary, and in theory, it's going to make even large banks really restrict their lending, and that has a big contractionary impact to the economy. And that is something Fed Jerome Powell did highlight, that, hey, we know this is going to be disinflationary. We know this is going to be negative for growth in the economy, but we just don't know how bad it's going to be. We don't know, essentially, I'm paraphrasing here, if the banking crisis is going to get worse. But from where the Fed currently sits now, it doesn't look like this is going to cause a pivot or necessarily a U-turn in and of itself. We need more data. Data dependency also came up yesterday as well, like it always does. Now, something else that is very interesting is the markets are pricing in about 75 basis points worth of rate cuts by the end of 2023. And Fed Jerome Powell said basically it's not going to happen. He said that's not our base case outlook. He also said the economic situation could change, right? Which does imply if the economy did get that bad, well, they would cut rates. But again, that begs the question of, if the markets want rate cuts so bad, the only way that's going to happen is if the economy does get bad. So on one hand, you get rate cuts in due time, but in the meantime, federal funds rate goes higher from here, which is not priced into the markets right now. Or on the other hand, the economy goes down the toilet and you get rate hikes a lot sooner. Which one is better? Arguably, both of them are not good. And that's the realization that I think the markets will eventually come to. You're starting to see them tick down here right now, but it's very uncertain. The markets do still have a lot of meat on the bone from the rally that we have seen today, but we have not gotten any new news. We got a Hindenburg short report on Square. If you guys want to talk about that in another video, we definitely can, but no market-wide news as of right now. We do have Janet Yellen that speaks at 1:30 p.m. today. Yesterday, a lot of people contributed some of that end-of-the-day sell-off to Janet Yellen, saying there's not going to be blanket FDIC insurance, meaning that if smaller banks, right, the ones that don't even have stocks, that aren't even listed, or other regional banks went bankrupt, number one, shareholders, you're done, you're wiped out. Bondholders, you're wiped out. But blanket FDIC insurance, and Janet Yellen saying they're not going to do that, means if those banks go bankrupt, you're not guaranteed to be protected. You're not guaranteed to get your money back. And I get why she has to say that, but it was definitely not good yesterday. So Janet Yellen's probably going to be the biggest, most impactful thing here on the day, and could really move things around quite a bit. The regional bank index, what is that? KRE is actually falling quite a bit today, heading into Janet Yellen. So that's going to be something to watch very closely. AMC stock doesn't really care. It's been up and it's down. It's up about 4.15% here at the time of recording this video. Hit a high of $4.68 earlier in the day today. So looking quite strong overall, well outperforming the indexes. If you take a look at AMC and the Ortex data here, 24.37% short interest of free float, 126 million shares that are currently sold short, cost to borrow average of 376.41%, cost to borrow max of 380%, cost to borrow minimum at almost 360%. Interactive Brokers has only about 10,000 shares that are currently available to be lent out, to be traded, with a cost to borrow rate of 214%. So cost to borrow rates are definitely a continuing story with AMC, because that puts a lot of pressure on shorts. And once we get new information, new news, or new thought pieces even on this court day, April 27th, that's going to move around AMC stock quite dramatically, and that's really what I'm personally waiting for here. I think there's a lot of opportunity once that does come out, especially with the options. On the other hand, GME is down about 1.5% at the time of this video, which granted, it has a lot of gains still, so like 1.5% is nothing compared to what we have seen the stock go from 15 just a week ago to 23.51 where it sits now. You can't really complain with that gain all too much. Now, as far as the data behind GME, short interest almost exactly the same as AMC, sitting at 24.29%, and really probably a lot of it might have to do with algorithmic trading, especially after today's drop. You would have expected probably to see GME go up again today just because their earnings have been so good. If you look at other stocks, right? Look at Facebook, look at any other company, and they have blowout earnings and they're up dramatically, right? GME, it's not getting the same love. Now, will it? I think it probably will. Today is one of those weird days in the markets post Powell. You got to let things digest just a little bit. The amount of shares currently sold short sits at almost 65 million. Cost to borrow average at 45.9%, cost to borrow max at 73.83%, and cost to borrow minimum at 17%. Interactive Brokers has the cost to borrow rate on GME at about 40%, give or take. Right now it's 40.3%. Parts of the day today it's been about 39.5%, so roughly 40%, with about 600,000 shares that are currently available to be traded. So I think that is pretty interesting. Another trade that you definitely want to watch closely. As far as the FTDs, we still have a bunch of them, so don't be confused. Today is March 23rd, so you do have about 11 million FTDs on AMC that come due today. Tomorrow is going to be about 10 million, and then the following week you're going to see 5.3 million on Monday, 4.3 million on Tuesday, on Wednesday 3.3 million, actually on Wednesday, or on Thursday 3.4 million, and on Friday you're going to get about 1 million FTDs that also come due. So as you can see from this chart, these white bars, those are the FTD numbers, and you have not seen anything like this ever, not even in the June rally. So there's a reason for this, and it will likely push us up higher sooner rather than later. I think we really just need some news, and I think that's the biggest thing that we are currently lacking right here and right now. As far as the economic calendar, what we can really expect over the next rest of today and tomorrow. Number one, I do want to point out that initial jobless claims did come in today. We'll go ahead and refresh this so we can give you guys what those numbers were, and it actually came in very good, I guess, for the economy, right, for the growth outlook, but it was overall negative for the odds of a Fed U-turn, right, for inflation going down. Initial jobless claims came in at 191,000. You were expecting 197,000, so about 6,000 better than expectations. Again, good for the economy, not so good for anyone hoping that inflation will come down, right? So that's it for today. Like I said, Janet Yellen will be at 1:30. It's not coming up here on the calendar, but she will be speaking at 1:30. So if you guys see some violent moves around 1:30 Eastern Standard Time, well, that is what it is, and be on the lookout for some headlines at that point. Now, durable goods orders, that's going to come in tomorrow. This will be very important as well on the front of how is the economy doing, as well as it can give you a glimpse on potentially inflation pressures, but not so much inflation, more on the economic side, but some small implications. 8:30 in the morning, durable goods orders month over month. Last month's reading for January, this data will be for February, so it's pretty lagged, was negative 4.5% for January. You are expecting a 0.7% rise for the month of February. If that comes in super negative, on one hand, it's good for inflation. On the other hand, it's bad for the economic outlook. And we got the Fed dot plot yesterday, and they lowered their growth forecast for the end of this year to 0.4% from 0.5%, so a 20% reduction in expected growth for 2023. On top of that, they're not expecting rate cuts. Nobody, not one Fed member, is expecting rate cuts by the end of this year. And I think that's the biggest thing from here that could give the market some downside, because we've been running up so aggressively based off of these banking failures and XYZ failure going bankrupt and the economy, blah, 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 to give us rate cuts. And apparently that's not going to happen. And Fed Jerome Powell has been very clear on that. So at some point in the near-term future, I think that will become a main concern for the markets, that we priced in this bullish outlook, and really the Fed funds rate is probably going to have to go higher and stay higher for a lot longer than what we currently expect, guys. So that is going to do it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comments section. Thank you guys for watching, and I will see you in the next one.